There are no sirens in England's housing market right now. No emergency headlines, no press conferences, no politicians declaring crisis. Most people looking at UK property data in December 2025 would see stability. House prices holding steady, mortgage approvals ticking along, transaction volumes near 10-year averages. But underneath that surface calm, something is fracturing. According to the latest Halifax House Price Index, annual growth slowed to just 0.7% in November 2025, the weakest since March. Nationwide reports 1.8%. Zoopla puts it at 1.1%. These numbers sound fine, boring even, until you realize what they actually mean. After adjusting for inflation, which sits at 3.2% as of December, real house prices are falling. Homeowners are losing purchasing power. And this is not a temporary dip. This is the beginning of a structural realignment. England's housing market is not collapsing in 2026. It is hardening, becoming less accessible, less forgiving, less functional. And the year where millions of households finally feel the full weight of this shift is not speculation, it's data. Welcome to Housing Watch. This is the story of a housing system that stopped working, while everyone was told everything was fine. And 2026 is the year that lie becomes impossible to maintain.
Let's address the confusion head-on. If England's housing market is breaking, why doesn't it look broken? According to UK Finance, gross mortgage lending hit £300 billion in 2025. Property transactions reached 1.2 million, the highest since 2022. The Bank of England approved 65,018 mortgages for house purchase in October alone. These are not crisis numbers. But housing markets do not fail like stock markets. They do not crash in a single day. They fail like glaciers, slowly, invisibly, until the entire structure has shifted and there is no going back. Consider the real picture beneath the headline figures. Halifax reports the average UK house price is £299,892 as of November 2025. That is a new record. But growth has slowed to 0.7% year-on-year. Once you factor in inflation at 3.2%, real prices have fallen by 2.5%. Homeowners are not gaining wealth, they are treading water. Zoopla data shows UK house prices rose just 1.1% annually to £270,300, again below inflation. And this modest growth is entirely driven by Northern England and first-time buyers stretching affordability limits. The South East saw growth of just 0.3% in Q3 2025. London rental yields are so weak that landlords are selling up rather than holding. This is not stability. This is exhaustion disguised as equilibrium. Markets operate on momentum. When prices stop rising meaningfully, confidence evaporates. Buyers hesitate. Sellers reduce asking prices. Transactions slow, and the cycle feeds on itself. Historically, stagnation after a boom does not end softly. It ends with correction. And 2026 is the year that correction becomes unavoidable.
Now we reach the mechanism breaking everything. Fixed-rate mortgages. Between 2020 and 2022, millions of English households locked into ultra-low mortgage rates. Base rate was 0.1%, two-year fixes were under 2%, five-year deals sat around 1.5%. Buyers stretched their budgets because borrowing was historically cheap. Then, everything changed. The Bank of England raised rates 14 times between December 2021 and August 2023, peaking at 5.25%. As of December 2025, the base rate sits at 3.75% after 6 cuts since August 2024. That sounds like relief. It is not, because the damage has already been done. According to UK Finance, 1.8 million fixed-rate mortgages are expiring in 2026. These are households who locked in at 1 to 3%. They are now remortgaging onto rates between 3.75% and 4.5%. For many, that means monthly payments jumping by £300 to £500. The Bank of England estimates 4.4 million households will face higher rates by December 2027. Around 420,000 of those will see monthly increases exceeding £500. That is not marginal pressure. That is structural affordability collapse. And this is not about reckless borrowing. These households passed strict affordability tests. They were stress tested at rates of 5 to 6%. But stress tests assume stable incomes and stable living costs. Neither of those assumptions held. Energy bills surged. Food inflation peaked above 10% in 2023. Council taxes rose. Transport costs climbed. Even as inflation has moderated to 3.2%, household budgets remain stretched. When mortgage payments suddenly jump, there is no slack left to absorb the shock. Arrears are not exploding, not yet. As of 2025, arrears fell to 92,100 accounts, down from 104,800 the previous year. But this is a lagging indicator. Defaults do not spike immediately, they accumulate. Households cut discretionary spending. They stop overpaying mortgages. They skip home repairs. They rely on credit cards. This is quiet failure, the kind that does not make headlines until it is too late.
Many are banking on further interest rate cuts to stabilize the market. This belief fundamentally misunderstands the problem. Yes, the Bank of England has cut rates 6 times since August 2024, bringing the base rate from 5.25% to 3.75%. Markets predict one more 0.25% cut by mid-2026, potentially bringing rates to 3.50%. Mortgage lenders have already priced this in. 2-year fixed rates now average 4.06% at 75% loan-to-value, down from 4.20% in October. But rate cuts affect new borrowing. The crisis lives in existing obligations. Households remortgaging in 2026 made their purchase decisions years ago. They bought when rates were 1 to 2%. Even if new rates fall to 3.75%, that is still double or triple what they were paying. Lower rates soften the blow. They do not reverse it. Moreover, affordability is not just about mortgage rates. It is about total cost of living. Average mortgage lending rates for first-time buyers stabilized around 5.4% in mid-2025. That is 160 basis points below 2022-2023 peaks. Sounds like progress, but food prices remain elevated. Utility costs have not returned to pre-crisis levels. Wage growth is slowing. The Bank of England projects private sector pay growth will fall to around 3.75% by late 2025, so real incomes are stagnating while housing costs remain structurally higher. Even with rate cuts, the affordability gap is widening. And here is the deeper problem. Rate cuts are conditional on inflation staying under control, but inflation has been bumpy. It peaked at 3.8% in July and September 2025, driven by food and energy volatility. As of November, it sits at 3.2%, still well above the bank's 2% target. If inflation spikes again, rate cuts stop. If global shocks disrupt energy markets or supply chains, rate cuts reverse. The era of ultra-low rates is over, structurally, permanently. Households expecting rescue from falling rates are waiting for relief that will not come.
England is not one housing market. It is dozens of local systems operating under different pressures, and those pressures are diverging rapidly. Northern England is outperforming. According to Nationwide, the North East saw house price inflation of 7.9% annually in July 2025, the highest in England. Northern Ireland posted 9.6% growth in Q3. These regions have lower starting prices, stronger affordability, and healthier rental yields, averaging 7.4% in Q4 2024. But the south is stalling. The outer southeast saw growth of just 0.3% in Q3 2025. London's housing market is particularly weak. Rental supply is recovering slowly, up just 6% year-on-year, compared to 20% plus increases in the northwest, northeast, and Wales. Landlord economics in London are broken. High purchase costs, low rental yields, and rising taxes are pushing investors out. Rightmove data from November shows asking prices fell 1.8% month-on-month, the largest November drop since 2012. The national average asking price now sits at £364,833, down £6,589 from October and 0.5% below November 2024. This regional divergence creates systemic fragility. When high-value regions slow, transaction chains break. A buyer in Manchester cannot complete their purchase because a seller in Surrey cannot find a buyer for their property. These chain failures cascade. Transactions that should complete in 5 months drag on for 8 or 9. And when chains collapse, confidence evaporates, sellers withdraw, prices reduce, the entire system slows. This is how regional weakness becomes national contagion.
Now we turn to the rental market, because what is happening there will define housing access for millions. Small landlords are leaving, not in a panic, quietly, methodically, and in devastating numbers. According to a spare room survey of 942 landlords in February 2025, 67% plan to either exit the sector entirely, reduce their portfolios, or shift to short-term holiday lets. Only 4.5% plan to expand. In London, 42% are planning to exit in 2025. Why? 3 compounding pressures. First, mortgage costs. Buy-to-let mortgages reset at higher rates, just like residential mortgages. Average buy-to-let rates sit around 4.99%, while rental yields average 6.94%. That margin is tight. Any unexpected costs, any void period, any tenant issue, and profitability collapses. Second, tax changes. Mortgage interest relief has been phased out. An additional 3% stamp duty surcharge applies to rental purchases. The 2025 autumn budget added a 2% extra tax on rental income. Capital gains tax increased. For many small landlords, the sector is no longer worth the hassle. Third, regulation. The upcoming Renters' Rights Bill will abolish Section 21 no-fault evictions, introduce open-ended tenancies, and strengthen tenant protections. Many landlords see this as removing their flexibility and increasing their risk. Right or wrong, 88% of landlords report having no confidence in the sector. That sentiment drives decisions. And when landlords exit, where do their properties go?